So you're a uranium investor in the year 2023, a year some might call a dead period in uranium investing. After all, uranium hit its peak in late 2021, and ideally, that should have been the time to sell. But you held on during the good times and the bad. But despite holding on, and despite all the sentiment from the vast majority of other retail investors like yourself, you're different. You're green-pilled. Or are you? In today's episode, we're going to go down the uranium supply and demand rabbit hole. Before we get started though, nothing in this video is financial advice. I am not a financial advisor. Do your own due diligence. It's your money, your responsibility. And one more thing, guys, if you enjoy this kind of content, hit the like button and hit the subscribe button down below. I would really appreciate it as it helps me with the algorithm. 80% of you guys who watch these videos are not subscribed. So I've got to come out here and ask for it. I don't like doing it, but it would really, really help me. Now, let's go ahead and dive in from a thread by John Quakes. And if you don't follow John Quakes, I highly recommend you do, especially on Twitter. And if you don't have a Twitter, I would open up a Twitter just to follow John Quakes' Twitter account. He posts up to date, up to the minute uranium news. And today we're going to cover one of those threads. Let's kick things off by looking at this uranium supply demand squeeze. So John here says the uranium investing opportunity emerges from an unexpected and accelerating nuclear renaissance, creating unprecedented demand for uranium already in multi-year deep structural supply deficit that can only be repaired by higher U3O8 prices. This chart shows us primary production over time, secondary production over time. Secondary production is a lot more expensive than primary production, mind you. And then we've got the reference case demand. This is what we expect demand would look like for the years ahead. And then this uppercase demand, this is kind of like your worst case scenario demand, your top level upper boundary demand. And in either case, supply and demand are going to run away from one another. So far in the year 2023, we've been able to maintain this deficit due to secondary production coming online. But for the years ahead, after 2023 and beyond, this secondary production isn't gonna be enough to maintain either one of these demand scenarios. We're looking at a supply gap that could stretch hundreds of millions all the way out in 2040, but let's not look that far. Let's just look towards 2027, 2029. Nonetheless, we're looking at about a 50 million pound supply deficit that cannot be serviced. Right now, there is a supply deficit, but we're able to push out production to get that deficit straightened out, to get that deficit closed because of this additional secondary production that we have. But that's not going to last forever. Let's look at another chart here from John Quakes. He says here, the uranium mining stocks investing thesis in a nutshell is that after Fukushima, the U3O8 price sank, new mine projects were canceled, and many mines were closed. Investments dropped as investors mistakenly thought nuclear energy is dying. But boy, were they wrong. Let's take a look at the uranium price stretching all the way back to 1968. We've had two massive bull markets in the books so far as it relates to uranium. The first one in the late 1970s that came to an end due to the 3 Mile Island disaster in 1979. In that bull market, uranium reached prices just north of $40. Again, inflation adjusted, this would kind of bring, that this would mean uranium would be sitting at around $100 to $120. In 2007, we saw the second peak of the second uranium bull market, topping out at just under $140 a pound. And we saw catalysts such as the Olympic Dam copper uranium mill fire. We saw the flood at McArthur River Mine, the flood at Cigar Lake project, the second flood at Cigar Lake. But finally, what was the death knell to this bull market was the Fukushima Daiichi disaster in 2011. And this is what depressed uranium prices for over a decade and a half now. But despite this drawdown, this depreciation in CapEx, this lack of investment coming into the space, what this did was this filtered out all of the weak uranium companies, the weak uranium mining stocks, and left us with only the best of the last bull market. And what we've had since 2017, we've had a bull market in the work. Now we're sitting at $53 just about, down below from our local top in 2022, where we hit just under $60 a pound. But nonetheless, the trend is up. And this was precipitated by the Russian invasion of Ukraine. Back in February of 2022, we saw a huge spike up to $60. And ever since then, we've continued to see this secular trend up year over year, despite a correction from a support line basis. As we can clearly see here, we've also looked at this from prior episodes. We have strong momentum in the uranium price, even though the miners aren't really showcasing that. Now, when it comes to actual exploration production of uranium, production has been increasing. Nuclear electricity production, mind you, has been increasing for decades now, starting from the 70s all the way out to the 21st century. In 2021, we had electricity production sit just north of 2,500 terawatt hours. It says here, nuclear reactor generated 2,600 terawatt hours in 2021, up 100 terawatt hours from 2020. This is the third highest ever total in global generation from nuclear power. So this means that the world is using more nuclear power than ever before. What does this mean? More demand for uranium. John Quakes writes here, nuclear energy has recovered over the past decade so that uranium demand today is back to where it was before Fukushima and is surging higher. A revival in nuclear energy has been underway for years, now kicked into high gear by energy security and net zero goals. So we had the Fukushima Daiichi incident here in 2011. And we saw this small blip in uranium demand. The trend was up, but we did see a bit of a speed bump in that trend since that incident. But nonetheless, 2021 was the first time we had recovered from that Fukushima incident. Global uranium supply and demand. Now, we've already looked at the supply and demand deficit in our previous slides. But John Quakes writes here, rising nuclear fuel demand as uranium production decline has led to a massive mined uranium supply deficit, estimated by industry consultants at 65 million pounds. So here we've got the established production here represented by these gray bars. We've also got the secondary supply represented by these black bars in this stacked bar chart. And now we've got the 2021 Q2, the requirements that were established by 2021 or on 2021 in terms of global demand. So clearly see the delta between what needs to be there versus what actually is. This is another slide. Existing uranium production and demand. We've got existing production here in blue, and then we've got the uranium demand here in green. And here in 2023, we can expect to see that deficit continue to maintain itself and then significantly taper off in the late 2020s. The uranium supply and demand balance likely to grow. Again, like we looked at before, production versus demand. We're looking towards a breakout of the production to demand ratio, the supply to demand ratio. One more thing here, guys. So, world nuclear electrical generating capacity. So, we're sitting at about 400 gigawatts as of 2021. And we're expecting just about a 25% increase in generating capacity of electricity generating capacity. And where is that going to come from? It's got to come from uranium. Exploration as well. So we've looked at the supply and demand deficit, but what can we do to kind of ease and subdue that deficit? Well, we could always explore for new uranium. Exploration budgets for U3O8 by country. So how conducive is exploration in various countries across the world, across the globe? Well, here we've got the uranium exploration budgets over time, stretching all the way back to 2007. And as we alluded to before, CapEx has dried up in the uranium space for over a decade due to the Fukushima Daiichi incident in 2011. Now, this is where we were in 2021. In 2008, we were sitting at $1.2 billion. So that's $1.2 billion in 2008. And as of 2021, we were just under $200 million. So a pretty substantial drawback in budgeting. So the CapEx simply is not there to incentivize exploration for U3O8. How is this supply and demand deficit going to be met? This looks at uranium concentrate production in the US from 1996 to the end of 2022. And uranium production in the US is next to nil as of 2022. And so all of this supply that's needed to meet the demand would have to be restarted through leasing, through exploration, through development of the mine, through production of that uranium, of that U3O8. It would simply take, it wouldn't be a matter of flipping a switch. We would need many years to get that uranium in ground to above ground and contracted with the utility companies. So here's a look at the current status of the U.S. uranium industry, stretching from 2007 to 2021. And this kind of breaks down the exploration budgeting the uranium mining budgeting across these years. So exploration has dried up here. So exploration represented here in gray, which looks like 300 people in persons here. There's not many people working in exploration mining, according to this chart, as of 2021. The head count that goes in with any of these levels of uranium production, whether it be the exploration, the mining, the milling, the processing, the reclamation, and uranium withheld, has all gone down. So the world needs new uranium mines. So we've been seeing a depletion of in-ground production inventory. So the uranium that's actually in the ground that we know can be mined has been depleting. So this chart looks at just that. So this is net requirements growth and then the pounds depleted here in blue. So we've got the pounds depleted represented by these bars. And then we've got the requirements for demand here represented in this green line. These are the requirements for pounds in the ground to match the demand in the market. And in 2023, we're only in the first phase of depletion. We're expecting these in-ground inventories, these in-ground production inventories, to significantly depreciate. And this is, again, what ties us back in to our first chart, which is this. So primary production is going to be severely hampered for reasons we've just illustrated. Secondary production is also going to be severely hampered. And also, it's way more expensive than primary production to begin with. So this is going to elicit and incentivize higher uranium prices. And higher uranium prices means higher uranium mining stock prices as well. So that's what I got for you today, guys. Let me know in the comments below. Do you think this is still enough reason to hold uranium stocks? Or is there something else that we're not putting into consideration? Now, I know a lot of people out there, they say, well, there's plenty of uranium out there in the ground. We just have to pull it out. But as we've seen in these other charts, in the last chart, in particular, that in-ground inventory is depleting severely. So I don't know what kind of data those people are looking at, but it doesn't match the data that we just looked at. Where was it? I think it was here. So, like I said, guys, so this is using TradeTech's latest proprietary assessment of in-ground production inventory. Let me know in the comments below. Are we missing something? Or are you simply not green-pilled enough? I'll see you in the next video. Bye, y'all.